There's a difference between physical occupancy and economic occupancy. So if they send me a rent roll and it shows 95% physical occupancy, like that's great. Like that's good. But on the economic occupancy, I have to assume that there's maybe, 10% of those people that maybe shouldn't be there in the first place, or, meaning like if the property knew they were going to sell, they started putting in, they maybe became more relaxed.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome back to Decoding Cash Flow. Today we have a very special guest, Wayne Courreges. Wayne is a managing partner at CREI Partners, a firm that currently manages over 50 million in asset across Texas, Louisiana, and Alabama. As a lead sponsor and general partner, he spearheads both the investment life cycle and investors' relationship for the company. Wayne's real estate journey began in 2007 during his service in U.S. Marine Corps. He later built an impressive 16-year career with commercial real estate firm before transitioning full-time to real estate investing. So Wayne, welcome to Decoding Cash Flow. I just give a brief update I just spoke about a brief background about yourself, so I want you to give our listeners a little bit more in depth on how did you get started in real estate, as well as what is your main focus as of now?
Yeah, Ted. Hey, thank you for allowing me to be on your show and excited for the conversation today. So my background has always been in real estate, really since my high school days. I had a friend whose dad was a real estate developer, and I just really looked up to him, and I started getting the bug of investing in or wanting to invest in real estate. In 2003 is when I graduated high school. We were sort of in the thick of it with Operation Iraqi Freedom and such. So, it was really heavy on my heart to join the U.S. Marine Corps, which I did September of my senior year. So as my friends were stressing out over which colleges they were going to,
Mhm.
I had a pretty good senior year. Like I knew 2 days after high school, I was going right to the Marine Corps boot camp in San Diego. So I knew my summer would be in sunny San Diego. But uh, speed that up for a couple years. I bought my first single family home in 29 Palms, California as a rental, and didn't make any money off of that. I mean, there's a story on that if you want to go down that road. But what it did teach me is that scaling in single family has so much risk, and it's so much pain. It's such pain, many times, and we can
Yeah.
like I said, go into that if you want. But I joined CBRE in 2007, Fortune 150 company, commercial real estate company, and worked for them for about 16 years,
Okay.
working heavily on asset management and property management for institutional clients. And that's really set a great foundation for what we do now, right, in real estate investing, because I was always thinking like an owner of growing value and treating each business or each building as its own business, right? And
Mhm.
then really in 2019, I was just like having a kind of Jesus with myself of like, hey, what am I going to be doing? Like, I'm really good at managing these properties. I've done really well, financially, and done well for other clients financially, through operations. And so it just hit me like I need to start my own real estate investment firm. So I did that in 2019. I still worked for CBRE while building my business. Uh,
Okay.
it was transparent. They knew I was doing and building a business. And then in 23, it just got too difficult, Ted, to do both. I
Mhm.
was not doing as well as I wanted to be doing in with CBRE, and I wanted to just be doing more full time on my real estate investments. So I took the plunge from the W-2 and went all in. But for a while there, Ted, it was my 9 to 5 paid for my 5 to 9 type, that side hustle,
Mhm.
building up the business. So that's really more of the story of how I got to where I am today. But a lot of real estate and my background's what I know and love. So
Mhm. Right. So you spoke about, like, you had a friend friend's family who was in the real estate that inspired you to,
Mhm.
you know, jump into real estate? Any specific reason, like, yeah, why only real estate? What are the reasons that you like to highlight to our
I mean,
listeners?
for me,
Yeah.
it's like why, people want to be physicians or attorneys or teachers or
Mhm.
just for whatever reason, real estate was the bug that I had. I mean,
Yeah.
I became obsessed with it. I mean, like I said, I bought my single family home when I was 19 years old, and that was, really the starting point of my own investment journey.
Mhm.
I've always been heavily invested in real estate, not so much on Wall Street. I like the control over investing in Main Street real estate where
Yeah.
you have a physical asset and you're solving a big need, which is providing housing. So,
Yeah.
I think it's a win-win. So, we hold a lot of our net worth and, monies in real estate, but I don't know if that's more, it's not really investment advice, because I always feel like people should diversify. It's just what I tell people is just try not to always think of 401k. I call it
Yeah.
herd mentality, Ted. It's like people thinking they're investing in Wall Street and they've done really well over the last year. I think S&P 500 is over 30% return, which is
Yeah.
fantastic. But a stroke of a text message or excuse me a Twitter a tweet or Facebook or something negative happens in the world, that
Yeah.
30% is now negative 20%. So that was my always biggest issue with it. And then, oh, by the way, when you do sell that stock, you have a tax on it. So there's, on the real estate side, I just like the control factor of
Yeah.
it's a brick and mortar type property. It, it will do
Yeah.
well regardless of what's going on in the outside
You know,
economy.
yeah, that's absolutely true. That's what I also recommend. Don't put all your eggs in the same basket. Of course, you need to diversify. You have some in stocks, bonds, whatever you want. But
Yeah.
real estate is also, one of the thing you don't want to miss. The main, what I've seen is, as you mentioned, people mostly invest in stock market rather than real estate. Is according to my experience, past experience, what I think is most of the people who have 9 to 5, they are too tied up in the job that they're doing. They don't have the time to look into a good deal out in for the real estate, don't have time to manage them. So that's where, people like you and me come in, just help them out to make sure they understand the real estate, educate them, and then they can start investing however they want.
100%. That education was the real big takeaway there because, that's why I do these podcasts. It's our way to give back from an education standpoint,
Yeah,
because, you know, people are, they don't, it's not like they don't want to know. Once they have the aha moments of like, oh, I can invest. Because even
yeah,
like, I worked, it was probably 14 or 15, no, must have been like 12 years. 12 years into my commercial real estate journey
yeah,
working for CBRE, I somehow, I don't even know how I figured it out, but somehow I figured out, hey, you don't have to be just the wealthy guy or the institutional type client, the
yeah,
MetLifes, the Invesco, TIA Crefts, JP Morgans, et cetera, who are buying these real estate. Like you and I and our friends and family and colleagues, we can and pool money and buy properties
yeah,
together. And once I had that, and I was in the industry, like, so if I'm in the industry and I'm just figuring this out, uh, most people have no clue. So that's why,
yeah,
I try to educate as much as I can that you don't have to just invest in a single fit. Because that's really more the natural thing I see, Ted, is like
yeah.
they'll do the stock market and then they want to get into real estate. So then they buy
Mhm.
a duplex or they buy a rental. And then they realize I don't want to deal with toilets, termites, and tenants
Yeah,
because it's a second job. And then they they stumble across a meetup and then they learn about passive investing. And then,
yeah,
so anyway, hopefully those that are listening, like there's a better way of doing it, in my opinion, to scale your wealth without doing, anything other than, there's a lot of upfront work and we could talk about that.
yeah.
But after that, the actual day-to-day operation is handled by somebody else.
That's true. That's true. Yeah, we'll dive deep into those, how the passive investors can, uh, vet the details of the sponsors or vet the deals and how they can invest at the later part of the podcast. But before we go there, right, wanted to know more about your company, CREI in Partners, right? What are the main assets that you invest in, and which areas you? I told about Texas, Louisiana, Alabama, but in
Yes.
addition to those states, where other
Yeah.
places you
So
invest?
we're primarily focused. So we're a real estate investment syndication firm. We primarily focus on multifamily, value add multifamily
Mhm.
properties, 100 plus units, and we primarily focus in the Texas Triangle. We are lead sponsors. So what that means is that we control everything from sourcing to acquiring to operating to selling. Like we control the life cycle of the deal.
Yeah.
Um, and to do that, I feel like you got to be close to your properties. You got to be driving distance to your property. So I live right smack in the middle, excuse me, of the Texas Triangle. So
Mhm.
it's easy 2.5 hours to any of the major cities in Texas: Dallas, Austin, Houston, San Antonio, just because of strategically where we decided to, hang our hat.
Mhm.
But we've also done storage, but it's not your typical mini storage. It's these large 20 by 50 storage units. So we partnered on a deal in Huntsville, Alabama, and we brought that here to Bryan College Station area through a development. And so we do the larger storage, which we really like. We've got a build to rent community, 98 single family home that we're developing in outside Lafayette, Louisiana.
Okay.
Um, We've got 5 properties in Houston that are all multifamily. So we've clustered enough in Houston where
Okay.
we see a lot of synergies and expense reductions, driving net operating income, driving value for those properties.
Mhm.
And yeah, we've been buyers this whole time. I mean, there's a lot of
Mhm.
people that have been sitting on the sidelines, Ted, over the last couple of years, worried about interest. I mean, we've found some incredible deals this year alone. We got a loan assumption on 128 unit that was a 3.82% fixed rate, 5-year deal. And
Okay.
again, it was a loan assumption, a Fannie Mae assumption on that. The year before, so that was in 23, we bought a property, seller financing, 6% fixed rate for 5 years. So when people say they can't find a deal, and I see this I love it when I see it on social media. The people that
Mhm.
have negative mindset, negative attitude about what's going on in the world. I'm like, if you're not able to find a deal in this environment, you're just not looking hard enough, right?
Mhm.
Or you just already have it in your mind. There's no deals out there. So as a buyer, that's good. I want more people to think like that. But as a buyer, I'm not. I'm finding the needle in the haystack
Yeah.
opportunities.
Yeah. It's all about, the numbers need to make sense,
Yeah.
you cannot sit on the sideline because the interest rate is high. There
Hmm.
might be some places, maybe you can go direct to the seller, or there are many other ways you can find the deals. Let's take a look at your strategies. As
Yeah.
you mentioned, like you are able to find the deals. So what is the extra thing that you think you are
I
doing
mean,
that others might
I'll open
not?
the book because most
All
people won't.
right.
I always tell people like, I'll give you the whole playbook if you want it. Most people won't do it because it's a hell of a lot
Yeah.
of work and it's a lot
Uh,
of money. So a lot of
yeah.
people, um, you know, naturally broker relations are important,
Hmm.
and we foster those relationships once, and they know that once a deal goes on the market, CREI partners are not buyers. We are not going to
Hmm.
be caught up in a
Bidding
highest
war.
best
Yeah.
war. Even if we're number 2 or number 3 on the list who happen to win because we can close the deal, it's still not it's not attractive to me,
Yeah.
right? So
There's not much meat on the bone after that goes on the
right. So
market.
I'm
Yeah.
okay with a broker, and I'm grateful for brokers bringing us deals
Hmm.
before they even have a offering memorandum. And so the deals that we typically buy from a broker, it's because we've already bought several through them. They know we can close. They know they can go
Hmm.
to the buyer, or excuse me, the seller, and say, "Hey, this group has credibility. They can raise the capital. They can close the deal." And I think that's really important, especially in today's environment. The brokers
Yeah.
want an easy close, and they want to look the best, in front of the seller.
Hmm. Yeah.
So that's one piece. But really, where like it gets really, um, where people don't want to do the work it's finding the off-market opportunities. And we found, properties this way. And we invest in programs like CoStar. It's not cheap. We invest. So let me start with CoStar. So CoStar is great for the sense, and this is not for passive investors. Those listening to passive, this is just what you're sort of getting a glimpse of what
Active.
an active
Yeah.
investor is doing.
Mhm.
But we invest in a program called CoStar, which is, in my opinion, expensive software, but
Yeah.
it has a pretty good database of all the properties in a given market. And then we go in and say, okay, well, we're looking for a 1980 or newer 100 plus unit property in a certain area. Even though we say like, oh, we're investing in Houston. Well, we're investing really in a quadrant of Houston. It's not all of Houston. And same with
Yeah.
San Antonio or Austin.
Mhm.
So you sort of find those properties, and then from there you at least get an idea of the at least the name or the address, right? And you can go to the appraisal district website and put in the address, find who the recorded owner is.
Mhm.
And then that recorded owner still doesn't give you who the actual owner is or their information. So then in Texas and most states, you have the Secretary of State. So you go to
Yeah.
their website, put in that, now that you have that
Company
entity,
name. Yep.
company name, go into the Secretary of State website. And then from there, you should be able to find who the true owner is. CoStar has some of this information, but it's not always accurate. I tell
Yeah.
you, like, some of our property is still not accurate on CoStar. So it's a starting point. It's a good resource to learn about the market, submarkets, maybe who the other comp sets are. So we use that as a tool. But in the sense of doing grunt work to find who the true owner is, and then it's just reaching out to them and starting to build the relationship. One property, it took about 2 years of us
Mhm.
building the relationship before they sold it to us off market. So that's one way. But the another way that I'm really excited about, and Ted, I haven't really talked about this on many podcasts. So
Yeah.
again, most people will not do what I'm telling them to do on the active side. But it's really, I don't know if you've heard of TREP, but TREP has access to all the loan data, right?
Mhm.
CMBS,
Yeah.
Fannie Freddie. So they have access to all this data. And so we've bought into this access. Again, it's not cheap, but we bought into the access, and we're able to see, properties based on our defined areas of where we're wanting to buy, properties that may be on the watch list with the lender, or if they're 30 days behind, 60 days, 90 days, or hey, they bought the property 3, 4 years ago. Well, now that we know that, okay, they bought 4 years ago and based on TREP, we have all the data. It's 100% accurate because it is required by the U.S. government to have all these lenders upload their information
Yeah.
that flows up into TREP. But you have access. So, okay, they bought 4 years ago. They have a 7-year loan or 5-year loan. They're likely going to be selling in the next year. So you have
Mhm.
access to data where you can start being proactive and finding struggling properties. You can find data and with loans of like, okay, we know they're going to be maturing because as you and I know, refinancing in today's environment is extremely difficult. And in
Yeah.
most cases, if you have to refinance, you have to bring in more capital,
Yeah.
right? So if you're able to get ahead of that as a buyer and find those opportunities, you can. So we use that, and then we also use Red IQ. Red IQ is another. It's to me getting a deal flow and getting the information uploaded into a portal where it can extrapolate rent rolls and income statements at a pretty fast pace and to see if it even makes sense because we don't want to spend a whole lot of time with a property to see, we spend hours on it just to find out it doesn't really work.
Yeah.
So Red IQ helps speeds up that process. But like Trap and CoStar, and then just doing the grunt work of once you find, or if you have 10, you don't have to spend all this money. We're doing this because we've scaled to a point where, we're doubling down on our real estate investments. But if you're starting out, find, 10 properties or however many properties you're looking into and go through that process. Appraisal district website, find the LLC entity, go to the Secretary of State, find the true owner. And then I'll give you one more nugget. Use benverified.com or some other type
Mm.
of skip
Yeah.
tracing software where you put people in and you're going to get 5, maybe 7 emails or phone numbers. You don't know which one's right. So then use there's texting websites like Textedly which is a program we use. Put all the phone or messages in,
Hmm.
and we text out. We call, we do mailers. It's a lot. It's a lot of work. Don't get me wrong, but if you want to find the blue ocean of properties, you have to do what most people in the red ocean of the sharks going after the same type of meat, like that. If you want opportunities to find deals that most people are not getting, you have to do the work. So I probably scared a lot of investors to start doing more passive investments. But I guess that's the point of all this is like we
Yeah.
are the people that are doing all this work so our investors can benefit from investing in
So
real estate.
absolutely, you said it right, right? When you find the off-market deals, that's the deal where you have the most advantage, in terms of the price point as well as the value adds that you can do to bring up the market value of the property.
Absolutely.
And yeah, so there is, of course, how there's some hard work that goes in the background
It's a
for
lot of time.
sure.
Yeah.
Yeah, a lot of time.
Yeah.
And when you mentioned, right, you reach out to these people through text, emails,
Mhm.
and how do you build the relationship once you get in touch with them, if they're not ready to sell?
Yeah. I mean,
What is the course? Yeah.
it's right now I feel like there's more people doing the text message because I get calls and
Hmm.
texts all the time and it gets annoying. What gets annoying is when I get a call and there's a pause and then it's somebody that I can't understand from across the world. It's like at the end of
Hmm.
the day, like if we're buying multi-million dollar assets and having somebody who's quick to answer, who understands what cap rates are, interest rates. So it's like, the outsourcing of work. Like for example, coming up with this list of properties through the appraisal district and Secretary of State. Like we outsource that. We used Upwork and there's skip
Hmm.
tracing type groups out there that will help provide this
Yeah.
data. I mean, it's grunt work, but it doesn't always have to be on you to do it. But the people that are doing the calls or doing the text, like those people need to understand the business. So, we've got employees that do those calls um, you know, and I just feel like that's important. Like the moment I get a call from somebody and there's a long pause and it's for somebody that I just,
Yeah.
I know that they're not a decision maker, right? They're not truly versed with what we're doing. So we get a lot of like stop, like text message back says stop, right? So that way you
Yeah.
don't message them again. That's okay. You just need one person, right?
That's
And for us, that's how, all the work that we did, it took one person to like message back and be like, hey, I'm considering selling. It took 2 years and we bought 101 units truly off market. Um,
yeah.
and going back to the broker piece, Ted, it's like, when I first started in 2019,
Hmm.
every deal that I got through a broker, I knew they had already gone to probably 100 other
Yeah.
people. And so by the time it got to me, it was just like I questioned it right off the bat, like why are they bringing this to me?
Hmm.
Now that we've have more of a track record, the broker opportunities are being really they're really great. They're coming to us like, hey, I know this off-market deal. Like they're actually bringing us deals that we would strongly consider, but it just takes time.
Yeah.
And so building the reputation, and then for us to like focusing on certain markets, we're really able to double down on those markets and build those relationships, not only with the brokers, but even the owners too through conferences and masterminds, et cetera.
Mhm. All right. Yeah. So that's your acquisition strategy we talked about right now. Before you put a bid on any properties, right? Before what are the specific underwriting thumb rules that you follow
Yeah.
to vet it out? Yeah.
It's a great question. So for us in Texas, I mean, there's a couple things. One, we'll obviously ask for the T12, the rent roll. We'll put it through Red IQ. We'll make assumptions. We never use, the information or broker if there is an OM or some type of
Prorated, no
information. Yeah,
prorated things.
we
Yeah.
we 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 know what it takes to operate a property because we
Yeah.
we do that already. So we already have our expense. So we just plug that in for 150
Hmm.
units. We anticipate to have 3 bodies, one person in the office, 2 people out of the office,
Maintenance. Yeah.
maintenance. So one person per 50 units. Insurance, though, we always get a quote from a broker. It's not going to be 100% accurate because
Mhm.
they have to go to bed, but they at least can tell you, okay, based on this area, based on the risk profile, the crime, et cetera, we expect it to be 1,400 a door, whatever that number is.
Yeah.
So that way we plug it on that. Taxes, always 100% of purchase price. I see a lot of people start getting funny with this. They're like, hey, I'm gonna do 85%, I'm gonna do 90%. Like, no, do
It's not gonna
100%
go
in
down.
Texas. Like, why? Why?
Yeah.
Just do it. And if the numbers don't work, they don't work.
They're not
And
working.
so we plug in. The expenses are the easy stuff for us because we know how to operate, and insurance is insurance and taxes is 100%.
Hmm.
So then we start looking at the revenue piece, and the revenue piece, it's taken the income that's already there, and say they're at 95%. Usually the first 6 months, I always trend 10% occupancy less.
Hmm.
Oh, and we can go down this road. So there's a difference between physical occupancy and economic occupancy. So if they send me a rent roll and it shows 95% physical occupancy, like that's great. Like that's good. But on the economic occupancy, I have to assume that there's maybe, 10% of those people that maybe shouldn't be there in the first place, or, meaning like if the property knew they were going to sell, they started putting in, they maybe became more relaxed, let's
Yeah.
just say it that
Yeah.
way, more relaxed on who they are bringing in
Bring
to
it
fill
in.
the occupancy. So, we want to be conservative on the revenue side of economic occupancy
Okay.
of 85%. We'll look at the bad debt, we'll increase bad debt. So really the first year we're really conservative on revenue because there's a lot of unknowns.
Yeah.
But I also still do, 2 to 3% rent bumps. We're doing 5 to 8% still in our markets. Um, and people are like, wow, how are you doing that? Well, a lot of the times rents are not already at market. Does that make sense? So like if in new construction, your rents may be already at market, but when you
Yeah.
buy a property, they could still be $100, $200 less than market. So a 7, 8% increase is still below market and less than what they would be paying down the road, right?
Yeah.
Because if
Absolutely.
they go, so it's sort of like, it is still possible in today's environment to get those increases. But from a conservative standpoint, we'll budget 2 to 3% year over year on that. And then we want to see 15% IR. That's a minimum. So if it's less than 15%, it doesn't work. We want to see it cash flow, negative cash flow. I've had one of those properties and like, oh, I'm going to renovate over 2 years. We're going to get the negative cash flow to positive cash flow. And like everybody who's done active investing over the last 5, 10 years has a story of a property not performing the way it should have. And a big part of that was because of negative cash flow day one. So
Yeah.
like that is no longer in my horizon. Everything has to
Yeah.
cash flow day one. It doesn't have to cash flow like amazing, but it
Yeah.
needs to
It needs to be cash flow
it needs to be
positive.
cash flow positive.
Yeah.
So, and I'll give you an example. We just closed on a property in August 29th, and our first distribution is December. And then the property I bought in 2023, we've cash flowed every quarter. We've sent out distributions. So it's a good feeling to send out distributions. Um, so that's what sort of on that
Hmm.
side, we typically do 7, 8% cash on cash. Now it doesn't happen year after
All the
year, but
time.
it's
Yeah.
but it's preferred. It accrues. So I like to see that. Debt service coverage ratio, at least a 1.25. But what happens if these numbers, like say it's not a 15%, maybe it's a 14%? Well, I just being open book here, like the initial go around, it's extreme conservative. Like, hey, let's be extreme conservative. But this is not black and white. I view real estate
Yeah.
investing as an art. So like, okay, it's like, okay, in a real world, not everything is going to go as bad as I underwriting. So there's levers that you can pull, right? And
Yeah.
so some of those levers, maybe I'm going to not be as aggressive on bad debt because I already have a low economic occupancy, so um, there's already some maybe levers that are already overly pulled, and so I can pull back. So at the end of the day, it's a feeling of we want the numbers to work, but if I feel like I'm just doing everything I can to make it work, then you just got to pass. And not spend a whole lot of time on it, right? And
Yeah.
then, from there we do our LOI. We have a pretty good idea of where the market. So a lot of times people say, "Well, get a lender's quote before." I don't think that's a bad thing to do. I think get the lender's quote before you send out an LOI. But I also we do these enough where we have an idea of where Fannie Freddie loans are going to be.
Yeah.
Um, and if it's cash flowing, it's not always necessary in my opinion, though. There's people out there that would say they wouldn't submit an LOI without a loan quote. I can see both ways.
Yeah. And talking about the numbers, right?
Mhm.
The returns.
Mhm.
Of course, everyone is going to try to get the best return out possible, right?
Yeah.
Sometimes it might go above the projection. Sometimes it might stick a little bit lower or closer
Mhm.
to the projection. But it's all about, how much experience you are in, as you said, pulling the handles to make it right.
Yeah. Yeah.
Yeah.
Well, and I tell the management team because one thing is we don't share our underwriting with the property management team. So the property management team, once we get a deal, LOI, we start getting our management team involved. They'll provide the budget. And again, some people are like, "Hey, do the budget beforehand." But if you're doing 10 to 15 underwritings a month, and you're
You have a
asking
pretty good
for
idea about
property
how much
management,
it's going to
it's
cost.
it,
Yeah.
it's too much time to do that. But anyway, so you get them like, hey, okay, got an LOI signed. We're now working through PSA. Well, now for us, it's time to engage our property management company. It's one company that manages our whole portfolio. They do a fantastic job. So they start digging in. Um, I know, by the way, they've already approved at a high level the property before we did the LOI because I always call them like, hey, do you know anything about this property? And if they're like, yeah, it's a good area, or it'll be fine, then we'll continue, right? But say the LOI comes, then we reach out to them and then they start doing the budget. Well, that budget is the numbers that we start tweaking again back in our pro forma. But I don't really change too much. I mean, maybe if there's a number that they think they can get other income higher because they're going to do more reserve parking, there may be some adjustments, but for the most part, our underwriting stays the same and we use the property management data for um
Just
the
cross-validating
expectations,
maybe, right?
right?
Yeah.
So they don't know like, hey, they're already exceeding our expectations. And so I think that's important is the property management, they need to focus on their budget where they think we can be, and then we have our budget. And then the reality is you'll probably meet sort of in the middle after you close the deal, and you're
Mhm.
still outperforming because the property management company doesn't know that they're outperforming because um,
You're doing a
you haven't shared your
conservative
underwriting.
underwriting. Yeah,
So
that's true. All right. And with regards to the investors' relationship, right
mhm.
now, what are the strategies that you use to build and maintain these strong relationships with the investors?
Yeah, so it's a really great question. So the last few years we've had a dedicated investor relations person on our team.
Mhm.
And so that's been really helpful. We added most recently a full time because previously that person, her name was Courtney. She did amazing, but she was more part time, and that worked great for where we were as a company. But we most recently added Shelby, who joined as an full time investor relations person. So it's sort of fun right now because about 2 months ago, we sat down and we went through all our individual investors, and I pretty much unloaded what was on my brain about each of those investors. What do they like? What about their kids? Where do they live? Like all that information was a data dump. So we put all that in there, and then she started reaching out to them to schedule calls, just having that personal element. We sent out Thanksgiving pecan pies to our investors who invested with us prior to 24. And then those investors that invested with us in 2024, they're going to get a separate gift in December. But we always like to send gifts through the holidays. We do a holiday card. So that's what we're doing now in the holiday season. But post holiday season, we do monthly updates. And on all of our properties, they get a monthly update. We share the full financial package. So they see the transparency there. They have access to the investor portal where they can go in and see all their investments, see the distributions. We've done, I was hoping quarterly, but the reality it's turned into semi-annual lunch or dinners. Last year we had a real nice steak dinner in Houston with investors. We've done it in Austin as well. And then we provide a lot of opportunities for education. We do a monthly meetup virtually. And so I don't know, it's a lot, but mostly what I find is the communication, Ted, the hospitality aspect of this business isn't talked about enough because at the end of the day, like I have investors who will text or call me and they get a direct response quickly back, right? And so having that one-on-one, but
Yeah.
also knowing when their birthdays are or just reaching out to them and checking in, all that the people
The
business
personal
stuff,
touch. That's what you're saying, right?
it differentiates
Yeah,
from
that's
other investment groups.
yeah. And what are the main marketing strategies like, to uh, get the new investor in your flow? Like,
Yeah.
what do you do?
So I call it a big fish. It's a fish net. Think of it like you're going
Mhm.
fishing, right? And within the fish net, the biggest thing that we use as the bait is education. I mean, that's what I'm most passionate about is
Yeah.
education. And
Yep.
so we've got a monthly meetup that we host virtually each month. We send out newsletters every other week with podcasts and blogs. Like this podcast here will be on one of those newsletters. Um, but we'll do blogs. Our website has an incredible amount of information of common terms and information about investing in real estate. We have a passive investor coaching program. Passiveinvestorcoaching.com is the website. And so we have all this heavy education piece. And
Mhm.
it's really just trying to give as much value out there to people who are open to learning about investing
Yeah.
as they build the relationship with us. And it's not this is not a like, will you marry me today type
Yeah.
conversation, which I think a lot of real estate people, they want to get straight to the investment. Like it's a nurturing, it's educating and nurturing. And when the opportunity comes, hopefully, you've done all that work prior and, that person feels enough trust and confidence in your ability to execute on the deal, they'll invest with you. For us, though, Ted, we only do 2 or 3 deals a year um, because we're so active on the asset management side. So for us, it's like we're not spread thin to a point where we buy a property and then, oh, we're already raising for another deal and we don't have the bandwidth to take care of the property we just bought. And so I see that
Mhm.
as a mistake a lot, unless you have the people, the bandwidth to do it. So when we send out an opportunity to invest, that's usually filled up pretty quick on our side.
Mhm. Yeah.
And it's just because they know that we don't have a lot of opportunities. So there's a little bit of scarcity in a way.
Mhm.
So that's, really focusing on education, caring, understanding what type of investor they are, Ted. Like, are they a cash flow investor? Are they an equity upside investor? Or are they both? Because
Mhm.
I've got investors who, I'll give you an example. We're doing a multifamily mixed use development here in Bryan College Station. To get that property, we did a seller financing of the land, but the
Mhm.
soft costs and the down payment, et cetera, I went out to, a few of our investors and said, hey, we're buying this land below market because it was an off market type transaction. So there's already equity in there. I can secure I can, if they lent us money, and this is the debt side. Not a lot of
Mhm.
people talk about debt. A lot of people talk about equity. That's what most people are like. Oh, I'm going to be an owner in a property, and that's fantastic. But there's also this debt piece, which is pretty powerful, especially if you have a self-directed IRA where you can then initially be the bank, or if you have cash life insurance, you can be the bank. And so, for us, for this particular deal, we did 15% payback in 18 months, securitized by the land. And so having those discussions with investors about tolerance, like one of those investors they don't want to have their money held up in 5 to 7 years. They love the idea that they can get a 15% return in 12 to 18 months,
Yeah.
and that it's securitized by the land, so that there's not a lot of risk.
Yeah.
So, I mean, you just from an investor relations side, not everybody is going to be put in one basket. You have to understand what their risk tolerance is. I've got one investor that she didn't want to invest in more multifamily because she felt she was already tied up in multifamily,
Mhm.
but she did invest in our storage development. And so those are, things that unless you're talking to them and staying in front, it's
Yes.
and I know I'm talking a lot. And the last thing I'll say, Ted, the the time to find capital is not when you have a deal. That's where people like, oh, I got a deal, and the
Yeah.
deal is here now. I need to raise capital. No, it's all this work. Think about the iceberg. All the work below the water is the reality of this business,
Yeah.
and the tip of the iceberg is the result of all the stuff that's underneath that you've been doing.
Yeah. All the
Uh,
hard work that goes, just to
Absolutely.
fill up that deal. Yeah.
Yeah. And then you get the
It's
deal, and then you're not having to tell people about who you are as a person. They already know who you are as a person
yeah.
and your ability to handle the good and the bad. Because this business is not just good, as you know, Ted. Like
Yeah.
we have to share our stories of pain, and how we gritted through those, and came through it.
Yeah. And the one thing that you say, right, about the land deal that you came across. So uh, there are many different type. The investors has a different appetite, as you mentioned, right? Some of them might go for a short period, uh, 12 to 18 months. Some of them might go for 5 to 6 years of investment.
Mhm.
That's what we also do here in our firm. We do the ground up construction. So for those projects, the investors, it's like 18 to 24 months period. They
Mhm.
get a high return. It's pros and cons, right?
Yeah.
You won't get no upfront tax benefits right away.
Yeah.
In the multifamily, it's the long term. You get more,
Yes.
tax breaks and everything. So it all depends on the investor appetite.
Yeah.
What is their strategy? What are they looking for? And
Right.
then you offer them deals accordingly.
Yeah. Because the self-directed IRA people,
Yeah,
they don't really benefit from depreciation,
yeah,
tax. Because, you know, so if they're investing and they're getting that 15%, I mean, it goes back to what we talked about earlier. It's not always just investing on Wall Street. It's being
yeah.
creative and looking at other alternative investments
Mhm.
or debt instruments that protect, your capital. Now, I wouldn't use that. I was telling someone last week, I'm like, hey, if somebody came to me and like, hey, can you loan me $100,000 to start my company? I guess that is an option that that person can do. But like for me, I want it backed by security. I want it some
Yeah.
type of collateral, and you get that in real estate. You don't really get that much in a investment into a business.
Wall Street. Yeah.
So and even though you're investing on that would be more on Main Street because it's a smaller company, a startup company, it's you know,
Yeah.
they're not building more dirt, right? And so
Hmm.
it's just being able to uh, back some investments up by real estate, I think it's just a
Yeah.
great
No,
opportunity.
absolutely. Absolutely. So now, talking about uh, your real estate, you have been in real estate for quite some time, right?
Yes.
So many years. So any specific situation, like tough situation, or I would say, challenging situation that came across. Um, if you can give our listeners a
Yeah,
little bit background on any one of them, and how did
100%.
you overcome it? Yeah.
Yeah. And that is a great question. And that's a question that they should be asking deal sponsors. And if they say, no, everything is good,
Yeah.
it's like saying your stuff don't stink. Like at the end of the day, like there's something that,
Yeah. That's
if they've been in the business long enough, there's something, right?
yeah.
So, I mean, we bought a property. It was a bridge loan debt, 2022. And, and we felt like there was meat on the bone because we are buying it below the value. It needed a lot of renovations. We knew there would be negative cash flow. And so, when we bought it, we implemented our business plan the first, 6 to 8 months, turned that property completely around. But what I didn't realize, Ted, is you can make a property look great. I mean, the roofs were leaking, HVACs weren't working, the pool was green, I mean, it was a wreck.
Uh-huh.
But what you can't fix is the reputation of that property. You can't fix that very quickly. And so, uh, it went from like a 1.7 star type property. We're up to like 3.7. So over time, we've like really tried to get that up. But I thought you can just, you know, some places you can just rebrand and like, but Google sticks to the address, doesn't stick to the name of the property. So
Yeah.
that was another like, oh man. But in the same time, our insurance doubled. We did buy a rate cap, but it wasn't so much the rate being where it was. It was that the market softened as well. It was like this perfect storm because, with declining rental rates and then you had inflation expenses. So anyway, it has aged me probably about 15, 20 years. But we never put our head under the pillow. The general partnership team, there was no drama. We always
Mhm.
worked through it. And right now, I'm hoping to get the loan modification document, this week, honestly, because we went through a lot of back and forth with the lender
Mhm.
in a partnership mindset and not a everything was always in a professional partnership mindset of like, hey, this is where we're at, this is where we want to go, and this is how we're going to get there. And in doing so, we were able to get a loan modification, a fixed rate debt, get out of the bridge, do a fixed rate loan, and get into an opportunity where we can get it to a cash flowing situation to either one day refinance or obviously sell. So you hear these stories all the time, especially properties bought in 2022.
Yeah.
The things that separated us that I'm proud of, even though like nobody wants to go through that process, nobody wants to go through a capital call. Like that's stuff that I just never want to do, but it's just part of the risk and the reality of real estate potentially.
Mm. Yeah.
If they're not cash flowing day one, like all of our future deals are doing, other than developments, is that you have to be transparent. You've got to communicate, and you can't put your head under the pillow, right?
That's true.
And
That's true.
I think
Yeah.
there were a lot of real estate investors who weren't talking about what was happening, and like we just stayed very transparent, in my opinion, with calls and emails. And now look at us. Like we're getting into a position where we're getting into a loan modification, which is really still hard to do, but we're able to get that to a point where we can, live another day. So, that's my one story. Thankfully, it's my only story of
That's
really
good. That's good.
before, but it's one that I'm happy to share because it does show that we have grit and there's transparency and we're not going to run away
Yeah.
when things get tough.
And that's the thing, right? The investors, they want the full transparency.
Mhm.
They want the details from the operator or the syndicator rather than getting it from outside the circle. That's where things get tough, like if they hear anything which you haven't been transparent about,
Yep.
yeah. All right. So, hey, Wayne, loving this conversation, but I also want to be mindful of your time. So I want to move into the final round of questions. Are you ready?
Let's do it.
All right. Okay. So which is the one book that had a most impact on your life or on your business?
The one book I would say Speed of Trust by Stephen
Okay.
Covey. I think that to me, I mean, I read it right when I first joined CBRE, like
Hmm.
2008, but it's a book that stuck with me because without trust, you got nothing. So whether it's your teams, your family, investors, uh, trust is what builds um, whatever goal or ideal that you
Yeah.
have to achieve.
Relationship, in business, everything, right? Yeah. All right. What are your main source of information to learn and grow?
So Learn and Grow, we're part of masterminds. So they're one, we heavily involved in Capital Collective or Raise Masters. That's how you and I met. And then we're also part of ACE Operators, which is through Sonia Sasadri on the asset management side. So we've invested in ourselves through these masterminds to get a lot of information about what's going on and how to do better for our investors. and for our investments. But we also are actively, participating in conferences. Most recently, we went to the IMN conference in Dallas, and so we stay heavily uh, involved through conferences and again those masterminds. Books are also important, especially for our new team members that we add to the team. Like I feel like especially they just graduated college last May, and so there's like sometimes feel like they're still in college because they're reading investment books and such. I stay pretty active on like Wall Street Journal and such, but I mean, I feel like we get our news like instantly through social media and stuff, right? So, there's a little bit of, staying what's going on with socials, um, keeping updated.
All right. Right. And what is the one habit that has been crucial in your success?
Yeah, show up every day. I mean, there's days,
Show
I
up
mean,
every day.
yesterday, like,
Yeah.
it seems like once or twice a week, I feel like I get a punch in the gut and I'm like, damn, like this sucks.
Yeah.
Because you're building momentum, right? You got 2, 3, 4 steps, and then you got 2 steps backwards. But it just show up every day. Well, no
Yeah.
matter what's going on personally in your life or what, and it's okay to feel sorry for yourself. Like give your time to like be like, man, that really isn't good. Like I'm good with that, but like that was yesterday. Like today, like I'm in a great mood. Like, hey, that was yesterday. Today's how we're gonna do it. And so that would be some advice to just show up and stay, just try to keep the right mindset,
Yeah.
and that could be a whole nother conversation, but it's been a big important thing for me this year is just keep showing up,
Yeah.
because
Stay
our
disciplined.
investors and everybody expects you to show up.
Yeah. So it's all about, like as you mentioned, right? Mindset, of course, plays a very important role. But once you see something, learn something, you're highly motivated at that point of
Yeah.
time,
Yeah.
and you got to, you know, uh, punch when the rod is hot,
Yes, that's
because
it.
after a while, that momentum that you have will slowly and gradually decrease. But
Yeah.
if you stay disciplined, right, as you mentioned, you have to show up, you have to be disciplined,
Yep.
regardless of what happens, right? And there's no looking back after that.
Yeah. I mean, that's why personally, Ted, like I come into an office, like this is there's no virtual back, like I'm in my office because I'm showing up. Like at home, I'd be watching Judge Judy. I'd be watching Still Wilkos. Like I wouldn't be in my mindset to
Yeah.
do what I need to be doing. Now,
Yeah.
will I work from home every once in a while? Yes. But for the most part, like for me, and everyone's going to be different, obviously, but showing up means coming to the office and being in the place with the mindset and the tools to, move the business forward.
Yep. All right. Last question, Wayne. That's the most difficult question, actually.
Mhm.
How can decoding cash flow listeners get in touch with you?
Oh, well, so, yeah. So, hey, I want to add value to those that are listening, and a big part of that is providing access to our um, passive investor coaching program. So you can go to CREIPartners.com, and through there, you'll see a link for our passive investor coaching program. But you can also go to passiveinvestorcoaching.com. We were charging. I'm not charging anymore. It's not a revenue generator. Like for me, I'm just trying to give value and education. It's over 8 hours of content of how to look at a deal, how to vet sponsors, how to do all the work up front. So that way you're positioned, especially coming in 25, that you're positioned to be able to provide, or be able to make those decisions on which investments are right for me, for you on the real estate side. You can also reach out to me direct by email, wayne@CREIPartners.com. Again, wayne@CREIPartners.com. But Ted, thank you for having me on. And
Yeah.
hopefully there's some value that's shared both for the passive investors and the active investors. I think we covered.
Yeah, we covered a lot for both the groups, so they will take all the golden nuggets that have been shared and take some action, of course,
Love it.
And Wayne, thanks for coming on the show. It was a pleasure talking to you.
Absolutely, Ted. We'll see you soon. Thank you.
All right. Thank you.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.